And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it.
Hello YouTube family, welcome to another video, and in today's video I'm going to talk about what to do when the stock market is falling or when your stock is falling. So the US market has officially, it has entered a bear market for some time now, but the last of all, the index has now gone into a bear market, which is the Dow Jones. So the Dow Jones as of Monday the 26th slipped into a bear market. It has now fallen by 20.4%, and that is really the threshold to say it is in a bear market. A bear market is when the entire market or a particular index has fallen by more than 20%, and it was the last of all of the remaining indexes. The S&P 500 has already fallen by more than 23%. This is another popular index, and the Dow Jones just consists of mainly 30 industrial companies, 30 popular companies. So it's one of the measures that investors use to measure whether or not the market is doing good or doing bad overall. On this channel I talk about many topics, and many of them involving stock picks and which dividend stocks, growth stocks, but investment psychology or investor psychology is very crucial, because the stock market won't always go up. There are times that you have corrections and the market will go down. So in this video I'll share some clips from Peter Lynch, who is a renowned investor. He had an average of 29% in his heyday as an investor. He managed Fidelity funds and is one of among the greatest investors of all time. So I want you to just check out these clips and hear from another perspective what to do in times like these.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that, because profits will go up 8% a year, and stocks will fall. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
At the time of his career, Peter Lynch managed Fidelity Investment, which was the largest mutual fund in the world. And he consistently had a return of 29% on average. But if you look at this would mean that he consistently doubled the S&P 500 return. And the S&P 500 normally beats a lot of professional managers. So just to show you the credential of someone like Peter Lynch can tell you that sometimes you just need to relax and know that stocks will go down at times. As investors, we need to look at stocks as business. These are real life businesses, companies who are generating profit and revenue. So you cannot just look at stocks as just what you see on the chart. If you view stocks as a business and you're investing for the long term, because if you're investing for the short term now, that's a whole different story. But for long term investors, if you view these companies as businesses, you won't worry about short-term market fluctuations. And also, we need to understand the business that we invest in. But when you understand the business we invest in, that will ease our mind and we know that this is just temporary.
I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range, or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we're being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logics, I had a syllogism and studied these when I was at Boston College. there can't be that many people who can predict interest rates because there'd be lots of billionaires.
So, if there's three things I wanted to take from this overall clip, I want it to be these three things. Number one, research what you're buying. Understand the company that you're buying. And if you're taking recommendations from an advisor, ask them about their assumptions and different detail about their analysis. Number two, understand that this is a game of patience and discipline. I'm talking for my long-term investors. So you know that sometimes you have to be willing to hold out for a year to 5 years. It all depends. But it's a game of patience. And number two, you must understand your time horizon. If it's money that you want, for next year, your school fee next year, or for a marriage or something, that money really shouldn't be in stocks. Or if you're going to really invest in money, you could put it in preference shares, or you can put it in bonds, or you can try other instruments. So you must understand your time horizon and what really fit you as an investor. So I hope that this video has assisted you in understanding about market decline and bear markets, because some of the time persons become anxious when they say the stock market is falling off a cliff. But we must understand that human nature hasn't changed over the years. It's the same thing. It's just happening over and over again. So please share and like and subscribe to this channel, and see you in the next video.